I think the markets in general have all been impacted one way or another. Some things positively impacted, some things neutral, some things negatively in general. Certain sectors, of course, have been impacted more than others, whether it's big or small companies. And I think that's really the main theme as far as tying to both credit and the lower middle market. It depends a lot what the business does and how the business is able to operate. One of the things we have seen with lower middle market companies as far as operations are concerned is that they tend to have more nimble teams and cultures. If you have to rally 100 people versus 10,000 people, you can figure out game plans that are going to fit smaller teams often a little bit easier, and the ability to communicate and understand your employees and have that culture be tighter to try to create working environments that are going to work for people. So what we have observed as a lower middle market investor is actually a lot of resilience from these private business owners, largely due to the fact that it's easier to have a tighter culture with a smaller team. Yeah, a ton of evolution. I think that the world is bifurcated right now as far as what we're seeing from investors. Investors, on one hand, are looking for safe, stable yield. As you know, yields in Europe, the U.S., most emerged markets are very low and lower than they generally ever have been in history in many cases in many products. So there's a demand for yield, especially as populations are aging, creating even more demand for yield product in general and less correlated assets, which is where there's a lot of interest in private credit. Going to the other end of the spectrum, there are people that are saying there's a downturn, I want to make some money off the downturn. So looking for opportunistic situations, looking for challenges where they can make higher returns and more stressed credit, less efficient markets, the lower middle market, you mentioned non-sponsored. When you get into the non-sponsored lower middle market in particular, the banks aren't frozen, but what I would say is they're gelled. So some banks are moving, but they're moving at a gelled pace versus a frozen pace, which creates a lot of uncertainty for business owners. Overlay that with the retiring population and the demand for acquisitions that largely leads from both the retiring population and multiple expansion as businesses get larger. And that means that a lot of these private business owners are looking for strategic acquisition debt capital that we found an incredible increase in, that the banks historically have never been highly active, but they're even less active than before, which creates additional market opportunity in the non-sponsored space where we're seeing pricing and other metrics continue to improve. The private credit market has expanded dramatically over the last decade or so. And what that has created is a lot of different things. It's created strategies that are very differentiated. So I think one is you will have managers emerge from this market downturn really showcasing the merits of their strategy. So if you have people that have strong covenants, low leverage, and other things that might contribute to strong capital protection, I think this market is going to showcase that and really separate stronger strategies that are more alpha generating strategies from other strategies that are more beta strategies that are really market taking strategies and AUM gathering strategies. So I think investors will get a lot of great transparency, and I think you'll see some managers really struggle to raise capital and other managers really flourish post this pandemic. In addition to that, one of the other, I would say, newer products, we've been doing it at Star Mountain for a long time, but has now become much larger, is the secondary credit market, both of direct assets and fund positions. Given you have hundreds of private credit funds and tens of thousands of private credit LPs, naturally you'll have different people that want early liquidity, and the complexities of these credit strategies is really something that is new for people that have the ability to analyze the assets and the securities and the structures as far as secondary strategies in the private credit market, which I think is something new, and we've seen a lot of investors asking about differentiated strategies, including that.